Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. My name is Michael Baker, and I'm here with my business partner, Ross Marinell. Ross, how you doing this morning?
Michael, fantastic. What a beautiful day here in the Carolinas. Had an action-packed weekend. I know you have, and I'm ready to get rolling today. So, my friend, we are 1 week away from the end of the tax filing deadline this year. So we're about ready to put to rest tax season for 2020. How are we feeling about that?
Well, I think the CPAs are going to disagree with that because I can't imagine how many people have been put on extension yet again. But yes, it's coming. It's coming. And I suspect that a plurality of folks in the accounting profession are celebrating that this season is coming to a close.
Yes. So if you know any tax professionals, we all know the week after the end of the regular tax filing season, they are gone. Vacation, 1-2 weeks, not to be heard from. Don't bother them. Don't call them. Let them reset. All those extensions, they'll get back later in the year.
Exactly.
So kudos to all of our tax professionals this year, because what a incredible just tsunami of law changes to have to digest, and just how much change there was in the tax rules this past year.
Oh, they got put on a deferral mid-season. I mean, we'd already started this year before they decided to extend the deadline, and they did that mid-season. So I can't even imagine what that did for a lot of folks.
So I thought today maybe we could start off with just a few quick tax stories that popped up, and I want to start off with a couple of little. So I surfed through Twitter, found some funny tax related tweets. I want to share a couple. Let's get a little lighthearted to be. Is that cool?
I'm with it.
All right. So there was one tweet that came through from Simon. He said, TurboTax is the worst computer game ever. There were a couple about TurboTax. You're like, it said I owe money. I just turned it off.
Yeah.
Oh, Here's one from Abel. Taxes really hate single people with no kids, bro.
You know what? Facts, man. That's true. It's like you're out there floating. You're on your own. You're on your own.
So this young man Brody said, doing taxes is so easy. I don't know what you guys are talking about. Step 1, get your W-2s. Step 2, give them to your dad. I don't know what's so hard about that.
Oh my heavens. Brody, meanwhile, is 28 years old.
So we'll keep the joke story going. So this past week, Elon Musk, the self-appointed Doge father of the Dogecoin mania, was on Saturday Night Live. Wasn't necessarily the response to the cryptocurrency people were hoping for, I think. But I had to do a quick just summary of. So right now we have Dogecoin, which is basically an open joke of a cryptocurrency, is now trading. It's the market cap of this is now hovering around $66 billion.
Yeah, I will say this though: don't say it's an open joke around like the true believers, because they'll be quick. They'll be quick to try to put you in your place about look at the performance.
Yeah. So, but I do think it's. At some point, just put it in perspective, right? Of how much money that is. So $66 billion. The week before it was trading over 80 billion. Just to give you an example, here's a few businesses that operate around our area. So 3D Printing, 3D Systems Corporation has a $2.28 billion market cap. So Dogecoin, 66 billion. Pinterest, $36 billion market cap. Just very popular stock. Just thought I would throw that out there. This one really got me. So Duke Energy, one of the largest corporations in our community that employs thousands and thousands of local people, has a market cap of 78 billion. So at some point last week, Dogecoin had a similar market cap as Duke Energy. It is a little absurd. You just think about how much money has been accumulated in these cryptocurrencies and how fast it's happened. That's a really massive influx of capital. I mean, any quick thoughts on that?
Yeah, this is what happens when you print trillions of dollars and you give a lot of it to teenagers and people who have Robinhood accounts. Lots of young kids at home last year couldn't do a lot of stuff, got hyper interested, I should say. Hyper invested is probably not too inaccurate
true,
itself.
Probably, maybe.
But they basically, couldn't think about it. Couldn't go to school, couldn't go to college, trapped at home, internet connection.
Sports shut down.
Sports were shut down. What became like the game, video games and investing in the stock market, because that was like the big action. And the government put money in a lot of people's pockets. And so, like anything, there are residual, side effects, if you will, or impacts that happen. And I think this is one of them. You have a lot of people who've decided, look at the GameStop saga that happened earlier this year. That was essentially a host of people collectively deciding, hey, we're going to do this. And, money has been made and everyone has seen it because it happened in the public square. And now this ball is rolling downhill, and everyone that has some leftover money or has some profits from last year's investing haul, then they're looking for the next thing to do. And they're looking for, they're not looking at boring companies like Costco, right? Like Costco, that's boring. They're like, oh, tell me a story. And so, Dogecoin fits the bill. And you've got the prophet himself, Elon Musk, out there saying stuff, tweeting stuff, and talked about Tesla being a religion, and there are people that are wholesale. Anything that Elon is about, they are going to follow and be interested in. So hey, we'll see what happens. I think this is going to probably end up hurting a lot of people. But hopefully not.
Think about the same thing. It's investing is a zero-sum game. So there's a winner and a loser to every transaction. So just tread carefully out there. If you've made some significant gains, just be reasonable. I know it's hard to be reasonable in a very unreasonable market, but try. All right. So next up, quick story here this was MSN.com. There is a IRS backlog of tax returns of about 31 million. So I was talking to a few people last week that were sort of waiting on or wondering when they may see their return coming.
Oh, like a refund.
Yeah. So the Taxpayer Advocate Service, an independent arm of the IRS focused on tax filers' rights, the agency is holding almost 31 million returns for manual processing just ahead of the May 17th tax filing deadline. So that backlog has grown by 2 million returns since mid-April. So part of the reason is there were some 2019 paper returns that held up the process because, of course, some of those returns were coming in during COVID lockdown, government shutdown. And I guess that's probably created a little backlog of work.
Yeah. Those people that insist upon filling out their paperwork by hand.
Well, remember, TurboTax is the worst computer game ever. So they just do it manually. It's less painful.
Yeah, I'm with you.
But it says that some of the newly filed tax returns are getting flagged by the IRS because of issues related to recent tax changes, federal stimulus checks, and one of those is related to the recovery rebate credit. So that's that's on Form 1040 that allows people to adjust their stimulus payments if they didn't receive all the funds to which they were entitled. So remember, you do have an opportunity to go back and reclaim those if you were entitled to them, but it has slowed the process of refunds. And so one of the things, my point of bringing this up is, we talk about this in previous podcasts, which is the goal of, in my opinion, the goal of tax withholding should be at the end of the year to have zero return, zero refund or zero owed. Right. Try and get as close to the line as you can. But some people like that, getting that big refund back, sort of a forced savings account.
Right.
The challenge is, when we have a situation like this year, the government is, getting to them, but it may be a while. So they're holding back some of those, those potential refunds because just the amount of backlog.
Yeah, I got nothing. I mean, I've tried to plead my case with people about, hey, I really think that you are over withholding. You're getting these huge refunds, and they will, take less money throughout the year because for some reason there's something chemically, I think, in our brains when we see that big check come back from the government, we think that that's somehow a win. And it's like, oh, we have this money. And I'm like, no, you've had that money all along. You just gave it away month by month and they're returning it to you. Wouldn't it be great to just have that money in your bank account all this time? But, some people, like you said, it's like a forced savings, and, they get that money back and that's what they spend on vacation. That's what they spend on, home improvement project. So, I
Right.
don't think it's the most optimal way to do things, but, again, people aren't necessarily rational when it comes to money sometimes.
Sure. Okay. I've got one more. This one was eye popping. It may take me just a minute to set it up,
Okay.
but we were just talking just a few minutes ago about sort of hyperactive trading and the gamification of stock investing, where people are making multiple trades and really short-term focused, and it's like you said, sort of hyperactive. So this was a post that came. This is on thinkadvisor.com. So this came from an advisor out of Arizona, and it looks like the forum that he posted this on was the National Association of Personal Financial Advisors.
Okay.
So it says here, this advisor explained that a do-it-yourself trader he knows, but is not his client, recently put his 1099-B information into TurboTax, and to his chagrin, had a 1.4 million in capital gains and a tax bill of just over 800,000. He never knew anything about the wash sale rules. So what happened? This trader started with an account balance of 30,000. That was $30,000 in his brokerage account. He had some 45 million in total trades with a net profit of $45,000. So think about the amount of activity over that period of time.
That's a lot of work. That's a lot of work for 45 grand, brother.
30,000 starting account balance grows to a net profit of 45,000. The challenge is what happened is, because he traded so quickly in and out of certain stocks, the wash sale rule disallowed some of the losses. And so instead of having what he thought was a $45,000 profit, which he would have owed income tax on, he ended up having a $1.4 million capital gain. And because all of the trading activity was short term, it's treated as ordinary income, he had just over 800,000 in taxes. So per the IRS rules, investors can't claim losses if they sell and buy the same or very similar securities within 30 days. So you can't deduct losses from wash sales unless the loss was incurred in the ordinary course of your business as a dealer in stock or securities. So basically, the wash sale rule kicked in. He bought and sold into the same or similar stocks. Can't imagine how many times, right? We would be speculating.
Multiple times.
And although he only ended up with a $45,000 net profit, he triggered 1.4 million in capital gain and $800,000 in taxes. So I think there's going to be a lot of traders this year, a lot of young investors that got started, that did something similar, that started with a relatively reasonable balance, right? 30,000 is not an accredited investor.
Yeah.
Traded intensely over the course of a year. And I wonder how many other people have suffered this fate.
I'm sure that there's a lot of people that are getting crash course lessons in, all the ins and outs of trading. But, I don't think that this is going to go away, man. I just don't. I think that the platforms that they're using, like Robinhood, for example, I'm not picking on Robinhood. I mean, they are who they are, but they've made it extremely easy and there's a great, from what I hear, client experience for people who use that app, but they allow people to have access to margin. I mean, to trade options, to do all kinds of stuff. And, I mean, anytime you give over complicated or complex tools to people who don't know how to use them, you're going to have people that lead the charge and, skin their knees a little bit. And in this case, this is somebody who clearly spent a lot of time actively trading in pursuit of profits, right? Obviously, they're trying to make money. Did I hear you say over $45 million in total transactions?
Yes.
So over $45 million in total transactions, $45,000 in profit. I won't even calculate what that percentage of profit is versus transactions. And now that bill is legit. I don't know how that they're going to reconcile that. They're probably going to have to deal with pay some attorneys, and
Oof.
and they're going to have to probably throw themselves at the mercy of the court. But that tax bill is legit. It's legitimate. So it will be interesting to see if we get a part 2 of that, how that turns out, because that's going to be a mess.
Right. So, kind of just to summarize, I mean, short-term trading, it can have some unintended consequences. One, you end up with mostly short-term capital gains, tax-wise. You have wash sale issues. You could have just simply an expensive tax filing.
Right.
I can't imagine, some of these folks having 300-400 page tax, just 1099, how long it would take someone to enter all that into your tax return. I mean, that's, you could have, significant costs associated with just filing it, tracking it all.
Well, if they got the summary document, that probably consolidates a lot of the data, and then they'll have all the, the page after page after page of the detailed transactions. But here's the thing that I was thinking about just a second ago. And I hate to pound this drum because it's going to make me sound like I'm an ancient fossil of a person, but which I'm not, but I am a dad and I think about these things. So parents, and if you've got teenagers and college kids, I don't know how old this person is. Could have been a 45-year-old man. We're all fallible. We all can make mistakes, but this sounds like something that a really young, inexperienced person would do that had nothing but time on their hands. Please know if your kids are messing around with these apps that trade, just know what they're up to. You don't have to be in their business. I know they don't want you in their business, but just, take a peek in there, because I can tell you who the first phone call is going to be. If your, 22-year-old son or daughter get some news that they owe the IRS $800,000. It's going to be you guys. So have just a working understanding of what they're up to. Give them some guidance and tell them, hey, make sure that they're not doing anything that's too risky. And if they don't understand something, get understanding, get some education first before you leave.
And I would just say too, a root cause of the fair bit of this over hyperactivity is that there's no longer a trading charge.
Of course. So that's what they want. They want people in there. They want people doing just what this person was doing, trading a million times a week. Why not?
I know. So, okay, Michael, fire away. You had a couple of things.
Yeah. I mean, one of the biggest, so this is a conversation that I find myself, I've had this conversation with a few people over the last couple of weeks, and I'll preface it by saying this. One, I am very much pro equities. I like the stock market. I like, the long-term opportunities that can be provided by investing in the stock market. I encourage people to do that. We have to understand the risk. We have to understand how we're investing in the context of a plan. All of that being said, I think we all need to check ourselves a little bit, because what we have experienced in the last, I would say, 12 to 14 months in the market has not been normal. It has not been normal, has not been a normal environment. Yes, nothing about the last year and a half has been normal. So that folds right in. However, this article that came out by Ben Carlson kind of summed up some of my thoughts, actually using data And so Ben wrote this article. It says, how to lose money when stock market is all-time highs. And the basic premise of the article is, we've all seen the stock market just rocket up from the lows of last year. And he says, during that time, nearly 96% of stocks in the overall U.S. stock market show positive returns, from 2020 to 2021, April, May of 2020 to April, May 2021. I mean, the market just went like a rocket ship.
So say that percentage again.
He says
stocks that went up.
I'll give you the exact context of it. He says 96% of stocks, I mean, just tremendous breadth in the market, went up, over that, looks like he's posting about, April 2020 to April 2021. And he just says, he's like, it's highly likely we'll never experience a 12-month period of returns like that. And the point that he is making is that if you just invested in something last year, the probability was really high that you made money, right? Mm-hmm. Which is why we're seeing, some of these additional behaviors where it was so easy last year that people were getting, that irrational exuberance, to use that word, right? Where they're just trading, they're like running around thinking no matter what we do, we can't miss. So we're going to 10X our activity because we can't miss. And so now what's happening is the market's getting much more narrow. And he says in here, he's got a chart in here. He says 2020 retail darlings such as Virgin Galactic is now down 67%, Peloton down 49%, Teladoc down 48%, Zoom down 47%. And he just goes on and on. He says it's worth noting many of these stocks actually still have really high positive gains, but those are some tremendous drawdowns. And he shows a chart of the Russell 3000, and there's a little disclaimer here, so I'll read it. It says there are only 2,880 stocks in the Russell 3000 at the moment. But of those stocks, he goes, 48% of them are down 10% or worse. 837 or 29% of the stocks in the Russell 3000 are in bear market territory, which is normal. That's what people don't understand. It's like, it's normal you think about the different types of companies, the different services, the different, microeconomies that these companies service, the cyclical nature of the market, the cyclical nature of all kinds of different markets. You're going to have, periods of time where it's extraordinarily rare for us to see what we saw last year, which is basically everything move positively, strongly, in that direction where it makes it look like investing is easy. Now the market's getting more narrow, and like, this is the environment. Now everyone's been teed up to think that it's just easy money. You got guys like Dave Portnoy, if you follow him on Twitter. I don't follow him, but enough people I follow him. So he pops up on my feed all the time. And he's like, stocks only go up. You get people saying stuff, and it becomes a game. And you think, oh man, I'm interested in stocks instead of investing prudently. And now we're getting back into a market where, we just had earnings, and more people are going to start looking at companies and valuations and earnings and what's going on, instead of just, hey, we've got stimulus money coming, recovery money, economy's reopening. Eventually that story is going to be over for the market, even though it's not over for us people in the economy. The market's going to be looking to the next thing. And I see that being a challenge for a lot of people coming up.
So to piggyback off that, because that's a pretty short time frame, we're 12 months coming off of one of the fastest drawdowns from all-time highs to bear market.
It's lightning
in
fast.
The history of the stock market.
Yeah.
Right. So we forget what happened in late February through March was that, the stock market dropped really quickly, really fast. And that created this, let's say a potential overcorrection, which then resulted in a lot of these companies rebounding. Like you said, 96% of stocks having a positive year from April of 2020 to April 2021. But if you expand that out and you look at a longer time horizon. I came across this article on Morningstar, and they were examining the decade performance from this is decades performance entire market. So 5,000 US stocks from January 2011 to December 2020. So this would be considered, I think, a pretty strong year for stocks. So that's coming off of the 2008, great financial crisis, 2008-9 into the next decade. And it looked at how many stocks were positive versus how many were down versus how many were just gone, non-existent any longer. And guess how many over that decade of stocks, individual stocks, were positive?
No, I'm sure it's going to be a much smaller percent than we think.
So the percentage of stocks that were positive during that decade was 42%.
Yeah. Not even half.
Right. With 36% down, 22% gone. Now, some of those were acquired and folded into larger, other entities, and some were then the opposite, which is they were out of business. So we think in the short range, right? We think, one of the challenges with investing is we think what's happening today is what's going to happen next year and a decade later. And oftentimes that's not the case. Things change. And the longer we look back, you think, well, golly, during that decade, how many stocks were positive? And you think 36% were down. Another 22% just gone. So either acquired or literally out of business. That's not necessarily an easy stock picking environment.
It's not.
If you have, like you said, a 42% chance of getting a stock that's positive, that doesn't mean it's excelling or beating the index or hitting the return that you want. And so, we've gotten, I think, a little too comfortable with just expecting all stocks to go up. It's just not the way it works.
Well, that's, we read a lot of Nick Murray in our office, and one of Nick Murray's famous quotes is human nature is a failed investor. And I think that is what we see time and time and time again is we let our emotions tell us a story, and then we act upon that. And then we justify it, like, well, look at this and look at that. And you really think, and we go back to look at Kodak, for example, right? Now, Kodak feels like an ancient dinosaur when we mention it nowadays, especially with the fact that we have unbelievable cameras in all of our smartphones. But there was a time, man, when Kodak was it, right? We had a phrase, Kodak moments. They were the company when it came to taking pictures. I remember vividly going to a wedding, and the bride and groom, one of the things that they had done is they had put the Kodak disposable cameras, one-time use, on everyone's table, and they wanted everyone to take as many pictures as possible. And then you had a bin to collect them. And, they processed all these photos, and they had all these candid pictures and stuff from their day. It was so cool. Gone. They don't exist. They don't exist anymore. Yes, they kind of became like a weird something last year.
It's like a little retro toy now, because both my kids now have a Polaroid.
Yeah.
Because they're so used to everything being digital that when they actually get to print something out and hold it in their hand, they're like, whoa, look at this. Yeah. It's actually novelty now.
And so
used to be the norm.
You think about, and this isn't me trying to make a prediction, but let's take a company like Zoom, right? So Zoom was around before last year. Last year just happened to be like the perfect storm for Zoom to exist. And they did, and that company is now expanded. But now we all know the game. All right, video conferencing, virtual meetings, all that. Who is now waiting in the wings? Now Apple for sure is going to be looking at this. Amazon's going to be looking at this. Facebook's going to be looking at this. The biggest of the big companies, Microsoft Teams, you're going to see everybody looking at whether or not that's a viable market for them. Who's to say that Zoom is still around 10 years, 15 years from now? Who knows? So it's really silly for us to think that, oh, we've got it all figured out, because if 2020 didn't teach you anything, it should have taught you that, hey, life can turn on a dime, and everything you thought everything you thought you could control can easily be like altered, tremendously in a blink. So that is why it's like we love investing, but we want to do it prudently, and we're trying to help people. Part of our job as financial planners, as advisors, is to help people keep themselves from blowing themselves up. Yes, sometimes we have to scratch a little itch, and we'll carve off a piece of a client's portfolio to maybe look at some individual securities. But there's such a significant amount of risk when you start to concentrate your investments, that's not the whole strategy. We don't want that to be the strategy. We want the strategy to make sense. And yes, if we've got a little play money or a little satellite portfolio over there that we're taking a little bit of extra risk, we know, hey, if things go well, wonderful. We're going to feel great. If things go bad, it's not going to blow up our entire plan. And I think that's what a lot of people are doing right now. And that concerns me, is you have a lot of risk seeking behavior where people think, hey, I'm going to use this opportunity to get rich. I'm going to use this opportunity to catch up, make up for lost time for years that I didn't invest. And maybe some of those people will be successful, but the probability is that it's going to get harder and harder and harder because the easy money was made last year.
Okay. So, I agree with the sentiment. We don't want to get too comfortable in the environment that we find ourselves in today. As you noted, there are a number of corrections underway already. A number of individual stocks that had seen exceptional gains from April to December of last year, struggling a little bit year to date. It's part of the process. Is that sometimes we overcorrect too. It's not uncommon to overcorrect in both directions, right? Where we fall a little faster and maybe a little further than we should, and we grow back a little faster and further than we might as well. And so that's the stock market game. When you look at the past decade of just that story I've brought up, one of the things about an exchange traded fund tracking an index, or whether that's SPY or some type of just market index that follows all those stocks, you're going to end up owning a little bit of everything, right? You own the index, so you're going to own those companies that would go down. You're going to own those companies that are gone, but you're also going to own the companies that go up. And what we know over that decade is that the market did grow. It's just not that every stock did. So we know that only 42% of the stocks that compile that index were positive, but they were positive by such a wide margin that it made up for the losers. And that's kind of the benefit of just passive investing, is you're going to own it all. But if the big winners exceed the losers, then we can end up in positive territory with a lot more diversification. So, all right, I think that's a good synopsis there. Anything else today, Michael?
Yeah, I mean, I wanted to point out that one of the big stories, at least locally, that came out in the past week was Governor McMaster. He's our governor here in South Carolina. He's now the second governor that has made an announcement that they're going to be again withdrawing from the federal unemployment assistance programs and return to pre-COVID unemployment, policies. And I think part of that is, one of the things we're seeing is you have a lot of businesses that are trying to reopen right now, and they can't get workers. These are going to likely be a lot of service industry positions, or, hourly workers. These businesses are trying to get reopened and they can't find staff. And there's a huge debate right now that's going to be fair. There's a lot of people saying, well, these people would return, if they were being paid adequately. I am much more of a proponent of letting the market actually determine what pay should be for certain positions. It's easy for a worker who is making $10 an hour to say, yeah, I deserve $15 an hour. Does that work in the marketplace? Let's find out. Right now, what's happening is the government is supplying an additional $300 a week on top of the unemployment benefits. And so there are a lot of people that are sitting home and they're doing the calculus. They're saying, well, I could go back to work and maybe I can make a little bit extra money, more than what I'm getting on unemployment. But right now I'm getting unemployment to not work. And unfortunately, there are folks that just don't get the math of that. And there are businesses that are hurting. And I've had some conversations with folks and, hey, we all can feel free to disagree. But at the end of the day, it's like the market needs to sort that out. The government coming in and creating an artificial competitor for labor distorts what should happen in the marketplace. And you're going to have businesses that can't operate and they're going to have to close. Now those jobs are gone, And so I think that, we're probably going to see more and more states follow suit, especially states that didn't fully close all the way or states that are trying to fully reopen. Those extra unemployment benefits are going to be going away. And so hopefully that will encourage more and more people to get back into the workforce.
There was a pretty big jobs miss last week, which highlights some of this, that there are opportunities for people to go back to work, but the financial incentive is in some cases on the side of staying home and collecting unemployment versus getting back into the workforce, because it's just financially beneficial to them to stay home with the added incentive. So it is having some economic impact because we're not seeing people fully return to the workforce.
Well, I think, part of the issue is, and I don't want to belabor this too much, but, back in the Obama administration, one of the things that they started doing is, remember they called them MIC jobs when they were counting, the people that were going back to work part-time, or it was like service jobs, or, not what you would think when you think full-time employed a job, but they started counting like every little job, that they could. And that's how they've continued to do that. And, right now, the article that I just peeked at for a second, it's there was something that came out that said, unemployment ticked back up. I think from YCharts, actually, one of their economic updates said it ticked back up from 6% to 6.1% is the unemployment rate. But, that doesn't count the people that only counts people that they call participating workers, right? The people that have considered disillusioned that they're not actively working, that doesn't count the people that have been dropped from the participation rate. And I think that there's a lot of people that just aren't actively looking for work right now for one reason or another. And, now we're in a situation where these businesses that are trying to reopen, they can't hire people. And I'm not smart enough to say I know what the solution is. I just know that when you artificially create a competitor for labor, which that additional unemployment does, there are people that could go back to work that are simply not going to until those benefits dry up. This is the same thing that happened in the financial crisis when they continued to extend unemployment. They kept extending it. They weren't adding so much extra, but they just kept extending the unemployment benefits. So hopefully this will continue to wrap itself up and we'll start to see some of these companies and businesses be able to get more people involved, because I've seen tons of help wanted signs everywhere I drive lately. So I know people are trying to hire.
Absolutely. Well, this is, so again, our tax professionals, you have 1 week to go. You're in the home stretch. We'll get you there. And we know that the new administration has put out some tax proposals that are circulating Congress. As those get closer to becoming law, we will talk about those in a little bit more detail and start to break down some of the effects of that legislation. And otherwise, it was a good show. Good to chat with you, Michael.
Absolutely.
And let's have a great week.
Yes, sir. Thank you guys for listening. And if you want to send us a question or something you'd like us to talk about on the show, email us at themoneyhuddle@vcplanning.com. And like always, we'll talk to you next time.